All right, so I'm Jean-Michel Beacco, CEO of Institut Bachelier, and good afternoon, everybody, ladies and gentlemen. Good afternoon, Marie. Good afternoon, Christian, and welcome to the International Risk Forum. This forum has been created 17 years ago by Louis Bachelier and its research foundations. 2007, quite the middle age for finance. Since then, we have tried to invite you all in spring in this beautiful place in Paris on topics which aim to gather public authorities, corporate and academics from all over the world, and we succeeded. Today, we will talk about big data and algorithmic finance, one of the hottest topics in modern finance. At Institut du Bachelier, Pierre-Louis Lyons, our scientific director, spotted the big data revolution as early as 2012 when he met Michael Bloomberg at Berkeley University. He realized that big data and algorithmic power could radically change the finance industry, providing we could speak both languages, AI and finance. This has been the path followed at ILB. On the opportunities side, big data can feed and improve existing models, enable real-time monitoring of markets, and help with risk management as well as product marketing. On the other hand, the growing use of algorithm and big data can also generate risks, particularly in terms of data protection, cyber risks, biases, non-predictability, blah, blah, default of robustness, and so on. Data is key, almost everything. Algorithms are somehow secondary, from my opinion. If you have meaningful data and you know them, no need of algos. That's why the use of human intelligence in finance is still essential, if not crucial. It is and will still be a brain business above all. In order to help the industry to the best of our ability at ILB, we have created an interdisciplinary program called FAIR, Finance and Insurance Reloaded. Green Finance and FAIR are now the two flagships program at ILB. FAIR has led to the creation of several research programs, be it shares or research initiatives, as well as one data-centric ANR project, regrouping data from both the algorithmic side of finance and the green side of finance. In 2015, Louis Boulanger started the data lab inside ILB in order to fill the gap between the theory, especially with AI running fast, and the practices still slow in the banking, insurance, and finance industry. The data lab is now about 20 engineers dealing with use cases from the entire industry, the BNP Paribas, Crédit Agricole, SocGen, Cardiff, on all the topics you will discuss today and tomorrow. Last but not least, the FAIR program is now steered by Marie Brière, who scaled it according to the industry and regulators' challenges, which are numerous. FAIR conferences with ACPR or asset managers are among the most popular events at ILB. Gathering these three pieces together, data, FAIR, and the labs, we are now in a position to create a new foundation sheltered at ILB, dedicated to numerical finance, alongside with PARC, the sheltered foundation dedicated to the green finance. The name of this foundation is already known, the code name. It will be Lagrange, as a tribute to the European mathematician Joseph-Louis Lagrange. We hope to soon be able to announce the creation and the fundraising, which will be necessary, and we hope to have all of you on board. back to the forum. Marie will tell you more about. I'm very proud and delighted to welcome more than 80 speakers on the research side of the equation as well as the practitioner side of the equation. This is rare and outstanding. We will also reward tomorrow 1 or 2 best researchers in finance and insurance, thanks to the support of the SCORE Foundation and Philippe Trainard, I'd like to thank namely. We will share 2 days of intellectual storming, and this is the result of collective hard work. That's why I will conclude by thanking the people without whom this would not be possible. Marie, Christian, back from, I don't know where, Canada, maybe? Yeah, Canada. The ILB team, especially Samia Brisson, Afida, who took the lead on the logistical side this year, Riyad and Feriel, and of course, all our sponsors supporting IEF, Institut Europe de Finance Foundation, and a special thank to Natixis Foundation, who has been faithful to this forum for the last 17 years, Michel Crouhy. Thank you. You can find the logos on the slide, by the way. Without further ado, I declare the 17th International Risk Forum of Institut du Bachelier open. I hope you will have a great session and walk away enriched with new insights, having pushed the boundaries of human understanding, and above all, being always more engaged at Institut du Bachelier within the research network. Marie, it's your floor now.
So thank you very much, Jean-Michel, and good afternoon, ladies and gentlemen. So as chairwoman of the Scientific Committee of the Risk Forum, it's my great pleasure to welcome you today for this 17th edition of the forum. And this year, it's on big data and algorithmic finance. So we're living in an extraordinary period, I think, with massive and rapid development of AI. Algorithms permeate our daily activities, and perhaps the most visible manifestation of this trend is the rapid development of large language models, whose capabilities are not only impressive, but also widely accessible to everyone. Generative AI automates today complex tasks that we thought could never be automated. So today, AI models are also widely used by banks and financial institutions for a wide range of tasks, from, for example, reducing the financial and operational risks and costs through automation of certain procedures like fraud detection, algorithmic credit scoring, email routing, etc. It also allows to exploit unstructured data to create investment opportunities, predictive analysis based on textual data, images, etc. And last but not least, it allows to better serve customers through service personalization, customer clustering, behavioral analysis, and robo-advice. And I think we're just at the beginning of a new phase of development and application of AI in finance. So more than ever, we need research to answer many questions and many challenges that arise. First, what are the risks of these technologies? What kind of risks do they pose to the financial and economic stability, also on inequality? What are the financial and environmental costs of these technologies? Second, what is the impact of the use of AI models on risks, biases, and discrimination? Third, what will be the impact of replacing part of the human workforce with AI? How to envision effective human-machine collaborations in the future? And fourth, what regulatory solutions should be provided for a smooth development of AI in finance? So to understand the risks and opportunities posed by these transformations, there is an urgent need for collaborations between policymakers, supervisors, financial actors, and academics. And I strongly believe in that. So I'm very, very happy that this year Supervisors such as ESMA, ACPR, and IMF are actively participating to the forum, participating to roundtable discussions, as well as financial players such as banks, asset managers, fintechs. They are all taking an active role in the event. We also received really great contributions from academics, and I would like to thank all of you for presenters, discussants, chairmen. I would like to thank you very warmly for your contribution to the event and for sharing your insight. Of course, I would like to thank our 3 keynote speakers, and I'm very happy and proud that we can welcome today Thierry Foucault. Thierry is professor at HEC Paris, and he will discuss the impact of alternative data use on market efficiency and asset management. Tomorrow, Rama Comte. Rama is professor at Imperial College, will discuss the use of tail-generative adverse networks to simulate tail risk scenarios. And finally, Christine Parlour, professor at Berkeley, will discuss liquidity fragmentation on DeFi exchanges. So finally, let me thank all participants. So thanks for being there today again. Like last year, you're more and more numerous every year, so we are very, very proud of the success of this event. Let me thank the members of the scientific committee, with a special thank you to Christian Gourierou. You've been there over the last years, and your participation is very, very important for the event. But let me also thank Louis Bertucci, David Bouni, Michel Crouhy, and Irène Monasterolo for organizing a session during the event. The conference couldn't exist without Institut Bachelier. A big thank you to the team, a big thank you to Jean-Michel Beacco for your support. Thank you also to the team, Samia Afida, Feriel and Riyad, for their crucial contribution. So without further ado, let me give the floor to Michel Crouhy. Michel, the floor is yours. You're senior advisor at Natixis, and you're going to chair the first session. Thank you very much, Michel.
Again, good afternoon, and welcome to the 17th Financial Risk International Forum. This year's this forum focuses on big data and algorithmic finance, such as the use of machine learning, AI, to address all the problems with new eyes, especially in the area of credit risk. My name is Michel Crouhy. By the way, I have only one sex. It shows chairman here and the chairwoman below, so only one. My name is Michel Crouhy from Natixis, where I chair the scientific committee of the Natixis Foundation for Research and Innovation. And the Natixis Foundation is sponsoring this plenary session. Actually, the Natixis Foundation has been sponsoring this event since the beginning, since the first edition of this Risk International Forum. So we'll start this session with our first guest speaker, Professor Thierry Foucault. Thierry's presentation will be followed by a round table. That's what it says in the program, but there is no table, it's not round, so let's call it a panel session on the theme application of machine learning and AI in banking on capital markets. It's obviously a vast topic, and we'll only touch upon a few areas. And I'll introduce the participant to this panel session after Thierry's talk. Let me first introduce Professor Thierry Foucault. Thierry is a professor of finance at HEC Paris, and is a research fellow at CEPR, the Center for Economic and Policy Research. Actually, I had the pleasure of meeting Thierry a long time ago when I was myself professor of finance at HEC, and Thierry was our brightest PhD student at the time, and since then, Thierry has been awarded many awards and honors. Thierry's research focuses on very important topics for us bankers: the determinants of financial markets, liquidity, the production of information in these markets, their industrial organization, and the effect on their effect on the real economy. Maybe I can digress a little bit here. Why? I mean, market liquidity is important for the banking industry. I've been in investment banking for more than 25 years, and my observation is that liquidity risk has always been underestimated, while it is, from my standpoint, a serial killer. Whether you look at the failure of Lehman Brothers in 2008, or more recently, SVB, Silicon Valley Bank, in March of 2023, they fell not because they were insolvent, but because because of liquidity risk, and then liquidity risk triggered the insolvency down the road. Right. So Thierry has published in leading academic journals, such as the Journal of Finance, the Review of Financial Studies, and the Journal of Financial Economics. Thierry was awarded a very prestigious prize, the prize for the best paper on financial markets and institutions, presented at the 2009 Western Finance Association, the WFA. He serves on the scientific committee of the AMF, the Autorité des Marchés Financiers, and on the research foundation of the Banque de France. The title of Professor Foucault's presentation is Displaced by Big Data, Evidence from Active Fund Managers. This is a very interesting paper, as you will discover, which shows how quants, financial engineers, who master the use of alternative data, such as satellite pictures of the parking lot of big retailers, will make traditional stock picking obsolete. And if there are students in the audience, my advice is to learn how to manipulate large databases and how to program in Python. So Thierry, the floor is yours now. You have 25 minutes for your presentation and 5 minutes for Q&A with the audience. Okay.
So thanks for the nice introduction. That reminds me of the time when I was a student at HEC. You know? So that's going to be, again, a defense, okay? So I'm going to talk about some research I have on the effect of artificial intelligence and big data on financial markets, on the production of information in financial markets. This is part of a broader research agenda, which is funded by a grant from the EU via its ERC scheme. So each time I present this research, I have to say it, so it's done. So what is alternative data? So this is, there is no clear definition, but this is any non-traditional sources of information that people can use for investment and pricing decisions. So typically this means information that is not provided by firms. In the past, you know, analysts were used to use balance sheet information, for instance, financial statements for their forecast. Well, nowadays they have access to much more information than that, which is coming from the digital footprints we live everywhere. So that can be, for instance, credit card data, that can be email receipt, web traffic, satellite images data like the one I'm going to use today. So this is the type of data that, for instance, I'm going to use in the research I'm going to present today. So that's big data. So typically alternative data is big data. Here we are using data from a satellite image data provider, RSmetrics. And RSmetrics is taking pictures of parking lots in the US for retailers every day. That amounts to something like 5 million data points every day. So that's big data. You need to have quantitative skills to process this data and to extract a signal from the data. There has been a growth, a steady growth of the number of alternative data providers, firms that specialize, that's part of the industry, specialize in providing alternative data. Typically, they specialize in a certain type of data. I have a paper forthcoming in the Journal of Finance with Dessin and Frézard, where we compute the number of alternative data providers every year since 1996, so we count more than 500. No. And a big question, of course, is whether there is information that you can use for investment in alternative data. That's not what I'm going to talk about today, because the answer is yes. There are many academic studies on the topic. In my paper with Frézard and Dessin, we survey more than 20 papers. They use different types of alternative data, like, for instance, data from Glassdoor and employee satisfaction, this type of things. We use data from StockTwit, for instance, in our paper. Yes, you can forecast at the short term earnings, for instance. Sometimes you can forecast short-term returns. There is data. This is true as well by reveal preference. Those guys, they are making money. They sell data to asset managers. Presumably, the asset managers are buying the data because they think this is useful. So there is information. You can get signal. That's just an example of what we do in the Journal of Finance paper. That's not the main part of the paper, but we do it anyway. We use StockTwit data, and we try to forecast. This is social media like Twitter. We try to forecast earnings, and we find that with this data, we can forecast earnings up to 1 year. So the signal is very short term, if you wish, but there is information. That's another paper. This is coming from a paper which is forthcoming in the GFQA. They use the type of data, the satellite images data that I have shown before, and they built a signal from this data. It's not very difficult. You count the number of cards every day for each retailer, so that gives you a signal. And they show you can forecast earnings next quarter. They show as well that you can build a long-short trading strategy. This is what is shown here on the right-hand side. For instance, the red part is the short part of the strategy where you are shorting retailers with lower than expected sales this quarter. And you can make a profit. Most of the profit is coming from the short part, presumably because short selling is more difficult. So yes, there is information. But this is the important point, and that's what I want to discuss today, which is not anybody can use this information. You need to be a quant. You need to be trained in data science, which, by the way, I think has important implications for the way we should train our students in business school, for instance. In order to extract signals from this type of data, you need to be good at data science. And of course, the industry is adjusting. That's a citation from the New York Times, which is mentioning that BlackRock is replacing parts of its traditional asset manager. They call them dyed-in-the-wool stock pickers, people, who were maybe extracting signals from balance sheet information, financial statement, maybe networking, good connections with firms. Now they are replaced by people who do not read financial statement anymore, but who extract information from satellite data feed, for instance, or from geolocation data, the quants. So we are seeing this evolution. That's not surprising because the skills you need to get the signal from alternative data is very different from the skill that asset managers had in the past. And so the question that I would like to discuss today in the rest of the talk is, how does this evolution is going to affect traditional asset managers? It's clear, that the quants, I can expect them to make, to increase their performance if they buy the data. They buy the data for a reason. This is because they think at least their back tests, show that there is some information. So the question here is different. I want to ask the question for the future of discretionary investors. Those who rely on traditional methods, most of them, in fact, who rely on traditional methods to extract, to make investment decisions. And the question is a big question. Are there at risk of displacement? There are big discussions about the effect of AI on the future of jobs. People say, even very qualified people are going to be displaced. That's an example of very qualified people. Asset managers are very qualified. They are trained in very good business schools, like HEC, for instance. So there is a question of whether those guys, are going to lose their advantage, basically. A second question, which is related, is whether this evolution is going to make financial markets more efficient. I don't like very much the word efficient. That's not sufficiently precise. Here I'm going to talk about informativeness, whether that makes prices more informative or not. So in the rest of the talk, I'm going to present results on those questions that come from two papers that I have, one theory paper with Jérôme Dugas from Paris Dauphine, and one sort of test, of some implication of this paper with Maxime Bonelli from the London Business School. So let me start with the theory. So I'm going to spend some time on the theory just to be clear on what I'm talking about. What is the mechanism that we try to, by which we think traditional asset managers might be displaced? This is not completely obvious. Huh? So let me spend some time on the theory, so that if you disagree, we can disagree on something which is precise. That is the theory. So the theory is the following. In our theory with Jérôme, we have, this is Grossman and Stiglitz, so we have one riskless asset, one risky asset that can be a portfolio of assets, a portfolio of retailers, for instance. And investors in our model, they can allocate their money to two types of asset managers. Asset managers can build portfolios with those two assets. Those that we call experts, think of experts as die-in-the-wool stock pickers, the traditional guys. So the traditional guys, they went to school, they have good education, their qualification is coming from that, so their ability to generate a signal is fixed. They cannot increase it, with the new data. They don't know how to use the new data. And then we have the data miners. Think of the data miners as the quants. The quants, when there is new data, they can take advantage of that by running, new research, by running regression, trying to forecast earnings, returns with the new data. And maybe, if the new data is good enough for generating a signal, they are going to trade on the signal. So the quants, they can benefit from the new data. They can increase the average precision of their signal by the new data. That's the key assumption of the theory. If you disagree with that, if you think experts can do it as well, then you disagree with the theory. So we solve for the equilibrium of the model. That means we solve for the way quants are searching for their signal, the optimal investment strategy, the equilibrium price. We compute the informativeness of the price about the payoff, so we can see whether the informativeness is going up or not. So the informativeness, this is the inverse of the residual uncertainty about the payoff of the asset. And that's the key part for the talk today. We compute the performance of experts and and data miners, the quants. So that's what I call stock picking here. How is defined stock picking in the theory? We define it like that. The stock picking, the stock picking of an asset manager I is defined as the realized return of the asset manager on its position in the asset, given the signal of the asset manager, given the precision of the signal. So let me explain. So this is just the product, the return of the asset manager on the risky part of the portfolio is just the product of the amount of asset, the fraction of asset under management, W, invested in the risky part, time, the abnormal return, the alpha, if you wish, on the asset, the risky part of the asset. And not surprisingly, W star is going to depend on the signal. If I have a good signal, I'm going to buy the asset. If I have a bad signal, I'm going to short the asset. And very importantly, it depends on the precision, because if I have a better signal, more precise signal, I'm going to scale up my position. Very, very intuitive. I face less risk. The important thing, so this is just a realization, so we average across all possible realizations of the signal, and we get this nice formula that tells me that the average stock picking ability of a given asset manager in the model is increasing with the precision of her signal, makes sense, but very important, it is decreasing with price informativeness. That captures alpha decay. That is, if price informativeness goes up, holding the precision of my signal constant, I'm going to be worse off. So how can I use the model, this very simple formula here, which comes from the model, to think about the effect of RS metrics introducing satellite images or data from satellite images for a retailer in the US. Let's say the retailer is Walmart, and RS metrics starts covering Walmart. What's going to happen in the model? The model tells me that the data miners, they are going to take advantage of that. They are going to buy the data from RS metrics. Maybe not all of them, a fraction of them, there are very few buyers at the end. But some of them are going to do that. The average precision of their signal is going to go up. So far, so good. But price informativeness is going to go up, because part of their information is going to go in the price. That's Grossman-Stiglitz. And so as a result, experts, they are going to be worse off. The precision of their signal is fixed, that's my assumption, and price informativeness is going up. The guys are worse off. So this is what we test with Maxime. We test exactly this mechanism, this particular mechanism, which is via alpha decay in a particular stock. It's difficult for us, you know, to classify asset managers as whether they are quants, whether they are experts. In the real world, you know, things are more blurred than in the theory, of course. So we look at, as well at the average effect across all asset managers. And when the fraction of quants buying the data is small enough, this is mu here, then you know that the effect which is going to dominate in the average is the effect on the expert. So the theory predicts that even if I look at the average guy without knowing the type of the average guy, in the data I should see a negative effect. That's what I'm going to test. So that's what we test with Maxime. So let me show you the result. So how do we test this prediction? We use data on quarterly holdings of US active equity funds. So we have a very large data set that comes from CRISP. And we combine that with data from RS-Metrics, you know, the data providers I have mentioned before. So we bought from them from 2009 to 2017, well, their data basically, and very important for the exercise here, the date at which they start covering a given retailer, Walmart, Home Depot, and so on and so forth. And that's so this is, you know, the coverage. So coverage starts in 2009 with 2 retailers, and then it increases over time up to 50 retailers in 2017. So, I mean, in technical terms, there is staggered coverage. That's good, you know, for the test. This is going to help us. And we do, you know, what economists do more and more. That is, we try to do a diff in diff, difference in differences. The idea is very simple. We are going to compare the average stock picking ability of the asset manager in our sample before and after the shock. The shock is the introduction, the coverage of a particular stock by RS-Metrics. Compare, that's the important part, this is the diff in diff part. Compare, you know, to the change in stock picking for the same fund for stocks that are not covered. In this way, we can control, for instance, the quality of the fund. Not all asset managers are born with the same skill. Okay, so how do we measure picking empirically? Very close to the theory. That is what I call picking for fund F in stock I in quarter T at horizon H, which can be, let's say, 1 quarter or 2 quarters. That's the abnormal return of the stock, abnormal measure with respect to the KPM here, multiply not exactly by the level of holding in stock I by the fund, that would be too simple. This is where there is a slight deviation from the theory, multiply by the deviation from a passive, you know, benchmark. Because of course, the fund could just, you know, hold the market portfolio, and you know, that's not, you know, active management. So here, really what we do is we measure the difference between the holding of the fund in stock I in a given quarter T relative to a passive benchmark. We use as a benchmark, we find the same results. So the way we do the benchmarking is not very important here. Very important, picking is measured at the stock level, not at the fund level. That's very different from, you know, the traditional papers on asset management that measures the alpha of a fund as a measure of performance. The alpha of a fund is not what I call picking. Picking is measured at the stock fund level. So the alpha is the weighted average of picking in all stocks. Okay, so this is just summary statistics. The bottom, this is the distribution of picking across all asset managers, all stocks, all quarter. Well, asset managers are not that good. The average value of picking is 0. We know that from the literature. If you pick randomly an active asset manager, it's not going to look too good. But of course, you know, there are exceptions, and some of them can be very good. And that's another message of the literature more recently, is that there is heterogeneity across asset managers. Some are good at what they do, but finding them is not easy. Okay, so this is the main specification for the diff in diff I was mentioning before, you know, this before-after comparison. So we run the following regression. Is a panel where picking is the variable we want to explain, if you wish. We have a stock fixed effect, fund quarter fixed effect that controls, you know, for the quality of the fund, if you wish. And very importantly, we have a variable, a dummy variable, covered time post, which is 1 if the stock I is covered, and after coverage of the stock. Before coverage, it is 0. For stocks which are never covered, this is 0. So the prediction of my theory is that if I run this regression, I should have a beta which is negative. The average effect of coverage by RS metrics on the stock picking ability of funds in our sample should be negative. Do we find that? Yes. So that's, you know, the estimation of this regression with our data. So in the first column, you know, I don't have stock fixed effect. I don't have stock fixed effect. I have I have a dummy variable that tells me whether a stock is covered or not. So this is just to show that, you know, this is positive. This is just to show that, if anything, funds, you know, in retailers that are covered by RS metrics, they tend to be better than what I have shown you in the previous table. In covered stocks, they tend to have better performance than in non-covered stocks, unconditionally, before coverage, basically, before coverage. But then, you know, when I run, you know, the previous specification, when I estimate the previous specification, I find as predictive a negative and significant coefficient for the effect of coverage. And we do that, you know, we use various specifications. Here, this is peaking at the 1 quarter horizon. You keep your position for 1 quarter, you liquidate. Then we have 2 quarters, 3 quarters. Up to 1 year, we find the same result. The average fund in our sample is negatively affected by coverage, exactly what the theory predicts. That's, you know, a visual representation. That's just an estimation of the previous regression, but I allow the effect of the treatment coverage to vary around coverage, before coverage and after coverage. Of course, you know, before the treatment, in principle, you should observe no effect, otherwise the effect is not coming from the treatment. That's what we observe. That's what the left part of the graphic. And everything happens after the treatment. And basically, the effect seems to become significant about 8 quarters after coverage. Okay, so now I'm going to move to another question, which is, the theory tells me that this is what I have shown is the average effect, but those that should really suffer are those who are what I have called the experts. Those who rely on traditional methods to generate their signals. So who could be those guys? So here we rely on the literature. And the literature tells me that, the academic literature tells me that there are at least 2 ways to generate signals in the all good way. First way, you specialize in an industry. There are papers showing that if you specialize in an industry, typically you do better. Maybe because you put more effort, you know, in expertise in this industry. Second good old way, well, networking. If you are located close to the headquarters as an asset manager, close to the headquarters of a firm, then guess what? You do better. Maybe because you meet directly the managers. That's one way to get information. So there are many papers showing that. The first showing that is Koval and Moskowitz. So based on this idea, we define 2 measures of expertise. One based on industry concentration, that is asset managers who have concentrated portfolios, we call them experts. A second measure of expertise, which is based on geographical location. So here we don't do exactly the same thing as usual, that is proximity to headquarters. We do, you know, proximity from the main area where a retailer has its stores. So in the US, you know, the US is divided in so-called metropolitan statistical areas. We count the number of stores per area for a retailer, and we say that you are an expert for a fund if your fund is in the area where the retailer has the largest number of stores. So 2 different ways to measure expertise. And so we redo our regression. We start from the baseline, and we add the possibility, you know, this is the term in the middle here. We add the possibility that the effect is going to be different, smaller or stronger, for those that we call experts. So my theory predicts that beta should be negative, but more than that, that this should be even more negative for the experts, for those that I have called experts, based on my classification. So is it the case? Yes. That is, for instance, look at the left-hand side here. So this is a classification based on industry specialization. You are an expert if you concentrate your holdings in the retail industry. So the red box here, the coefficient that corresponds to the red box, tells me that, first of all, yes, there is value of being an industry expert. That's what the literature has found. The coefficient is positive and significant. But this edge is going down after coverage. This is the box, which is the box in green here. As predicted, for the experts, the industry experts, the effect is more negative. If I look at geography, same message. Exactly same message. So your expertise is declining. You are competed away, by those guys who are the quants, basically. Your skill is less valuable. So what do? Well, one thing is to, reskill. You may take a course in data science and become a quant, so we cannot check that. But what you can do is, first of all, invest less or exit. So we check that and we find evidence of that. That is, the fund, which are negatively affected, or coverage, predicts, exit of some funds. And what you could do as well is to move to your next best option, which is move to a stock in the same industry where you are an expert, but which is not covered. So we check that, and we find evidence of that as well. That is, it seems that there is a reallocation of investment from stocks that are covered to stocks that are not covered in the same industry, for instance. So let me skip that. Remember that the mechanism is via price informativeness. So every effect is coming from the fact that prices are supposed to become more informative due to coverage because there are few quants that basically extract the juice from the data and trade on that and make the price moving in the direction of the cash flow. So is this the case? Let me finish on that. How do we measure? I mean, the big difficulty is to measure price informativeness. Informativeness is not exactly the same thing as efficiency. So here the way we measure informativeness is we follow the literature. We look, at whether earnings reveal a lot of information or not. That is, prices jump a lot at the time of earnings announcement. If prices jump less at the time of earnings announcement, that means that prices before the earnings announcement is more informative. That's the logic of the test here. So we measure, for instance, the so-called jump ratio, which has been used in the literature, which is the abnormal return at the time of the announcement divided by the total abnormal return around the announcement. And we find that, as predicted, the jump ratio is going down for covered stocks after coverage. That means prices become more informative before earnings announcement about future earnings announcement after coverage. So let me conclude. So what do? We find, in a very narrow way, in a sense, for one type of alternative data, we find that the introduction of this type of alternative data reduces traditional asset manager stock picking ability. This is a marginal effect. Of course, what I would like to do ideally is to talk about the total effect of alternative data. That I cannot do. I have only one very particular type of alternative data. The obvious thing to do after this research is to collect more alternative data and do more tests, basically. I think maybe more interestingly is to think about the broader implications. So I have mentioned implications for the way we should teach students. Data science is going to be, this is what Michel was saying, I think data science is going to become very important, part of curriculum in Masters in Finance. But I think there are other interesting implications. For instance, if you think about this shift of asset managers, traditional asset managers, from covered stocks by alternative data to non-covered stocks, that means that in the future we may see a segmentation. Covered stocks, you will have quants. Non-covered stocks, maybe that will be, the kingdom of the traditional asset managers. And then maybe that's going to generate systematic differences in the type of information in prices. For instance, maybe the quants are good at, speculating on short-term returns and short-term information, not so good at forecasting, cash flows in 7 years from now. Maybe the traditional asset guys and human judgment are good at that. So I will stop on that. Thanks for your attention.
Now we have a few minutes before the panel session for questions from the audience. Oh, you stay here. Can you? Yeah. Well, I'm going to ask one. Oh, yeah. Okay. Take the mic.
Good morning, sir. I suppose all these formulas you integrate probably in a software to run with Python language.
You mean the formula in the theory?
Yes.
No, we can compute them analytically. In the theory, everything is analytical. It's not very, the theory, the theory is complex, but this part is not very complex. So this part is you taking an average that we can compute, basically.
And when you function with IA, when?
I don't get the question, sorry.
Intelligent artificial software.
The link with AI, okay, yeah, good, yeah, that's very important. So in the paper with Jérôme is here, by the way. In the paper with Jérôme, that's the novelty compared to Grossman-Stiglitz. We allow for 2 dimensions. One dimension, which is the expansion, of new data, and we argue that this is pushing, the precision of the best signal quants can obtain. And there is another dimension that has more to do with AI, which is the cost that you need to pay to explore the data. Quants, they spend a long time, in fact, they have research team for that, just exploring data, backtesting strategies. If the cost of computing is going down, if they can have access to cloud computing, for instance, this cost of effort, is going down as well. So that's the second dimension that we explore in the paper, which, by the way, this dimension is much closer to Grossman-Stiglitz. That's like a cost of information acquisition that gives you more or less the same prediction. What does not give you the same prediction is the second dimension, which is not an existing model. The expansion of the universe of data, basically.
Yeah, I just have the mic. So talking about cloud computing, can you exploit this heterogeneity in the quality of the data? I guess satellite images are higher quality in sunny Southern California rather than other parts of the country.
Yeah, very good question. There are people who have tried to do that. We did not find any effect. Maybe because we lack power. Basically, our idea was that in quarters where there were clouds, above stores owned by Walmart, it would be more difficult for the quants to exploit the signal. We tried that. We did not find any effect. Maybe because of lack of power of the test.
Yeah. Okay.
Thank you. So great presentation. Maybe a quick question about, because you explore heterogeneity across fund managers, depending on how specialist they are. A quick question about skills as well. Did you try that? Because one of the big issues in this work displacement is that the high-skilled people will be replaced, or not replaced, but complemented with AI. So what about fund manager skills? And maybe one comment also on companies' behavior. That's also, what do you expect as a consequences also on firms' behavior? Yeah.
So these are 2 very good questions. The first question, ideally, would like to look at what happens to the fund managers and whether, depending on their skill, they are replaced or not. We don't have the data, but I think that would be a much more direct way to address the question that I was mentioning about displacement. For the moment, we just observe that if you are traditional, you are going to lose. So maybe, the BlackRock's reaction, which is have teams, with a mixture of quants, and is the good one. Regarding the second question, I think this is very interesting, which is firms, among the clients of those firms, the data sellers, you have firms themselves. Walmart, for instance, will be buying the data. So I expect that firms may change their behavior based on this data. For instance, they may disclose more or less information, or they may even change, the way they compete in the product market, for instance. In the model I was mentioning, that would mean that the distribution of the payoff, which we take as exogenous, might be affected. So that's, I think, a very interesting venue for future research, which is there might be a feedback from the availability of alternative data on the real decision by firms. That's something that would be very interesting to study. Yeah.
Well, okay.
Merci. Yes, in your speech, you talked about examples located in the US, such as Walmart. Now, if we look at a French, very domestic company, which type of alternative data provider would you recommend?
Okay. Well, here everything is US data. Many of those firms I have mentioned in my picture before, selling data, are based in the US. Sometimes they cover international firms, not only, US firms. They cover many different types of data. I don't have, an immediate answer to your question. I'm not aware, of alternative data seller in France. There are alternative data seller in France, but I don't know what stocks they cover. I don't know whether they cover French stocks and so on and so forth. It would be interesting to do the same, for France or at least Europe. That being said, something I learned from this exercise is that when you think about the value of alternative data, it's very important to think about the value for a given stock, because this is coverage. That is, not all stocks are going to be covered. So if you just look at the effect in general, it's very likely that you are going to find no effect at all. Because at the end, here I'm talking about 50 stocks in a universe of, I don't remember, but maybe 5,000 stocks. So I really need to be able to zoom on the stocks that are going to be affected. That's very important. So this is not feasible with any type of alternative data. Sometimes, there are too macro, for instance, for doing this exercise.
You have many sources of alternative data. Any idea of which data source, which type of alternative data contribute the most to future performance?
No, I would like to. That's a good question. But no, in order to address this question, you need to obtain different type of data. In order to answer this question, you need to obtain different data sets maybe from the same provider, but different data sets, and to make a systematic comparison between the predictability you get. It's difficult to get that. I was in contact with one of the data providers here. We try with selling many different types of data in the US. We try, to get just information about the date of the coverage. They didn't want to give us this information. So, there is some secrecy here. And if you want to go beyond this hurdle, you need to be able to pay industry costs, which is not possible for us.
Last question. Okay, thank you. You were talking skills and people, staff who was replaced by new skills. Do you also see in parallel migration of the allocation from traditional funds towards hedge funds who are more sophisticated?
Funds in our data set, we just have active equity mutual fund in the US. It would be interesting to add hedge funds to our data and see what happened. Whether there is migration, from active mutual funds to hedge funds, I don't have direct evidence. But there are people who have looked at that, using data on the type of LinkedIn data, for instance, the type of job profile on LinkedIn. And, so that would be a way to say something.
I think we need to stop here. And thank you again, Thierry, and the audience for the question.